Hello, everyone. Firstly, I'd like to thank everyone for taking the time to attend my presentation today. My name is Gan Leong, and I'm the designated fund manager for KAF Jade Fund. Today, I'll be sharing with you my views, on what I think of the markets within the Asia-Pacific region, as well as my strategy on how I plan to navigate through the current economic climate. We will also be spending a bit more time on the outlook of Chinese equities. This slide demonstrates the performance of various asset classes since the end of 2019. As you can see, the MSCI World Index and Commodity Index is the best performing asset class in the past 2 years. The strong performance of the MSCI World Index is largely due to the strength of the large cap stocks in America, which account to a large portion of the MSCI World composition. On the other end of the spectrum, the ASEAN region has been the worst performing segment, in which it is the only segment that is accumulating losses since the end of 2019. The MSCI Asia Pac Index, which is the benchmark for KAF Jade Fund, is up slightly more than 10% since the end of 2019. If we zoom in further and look at it from a year-to-date perspective, the best performing asset class this year would be commodities. We are seeing strong performance across all commodities, ranging from energy to industrial metals. Several factors come to mind when it comes to the strong performance we're seeing this year. The uneven reopening as well as supply chain disruptions play a role in the strong performance we see this year, especially after years of bearish performance. The MSCI Asia Pacific and the ASEAN index are still posting losses this year, with the MSCI Asia Pacific being down roughly 2% this year. However, the strong performance in the past few trading days have catapulted MSCI ASEAN to positive territory this year. Now, if we were to further break down the performance of individual markets this year, Australia, Singapore, Japan, Thailand would stand out as the best performing markets within these regions, with returns of 10.62%, 10.36%, 8.64%, and 7.31% respectively. China is by far the biggest loser this year, followed by Malaysia, which is rather unfortunate. The strong performance in Australia is largely driven by the strong commodity prices this year, as Australia have always been perceived as the best commodity proxy to global investors, similar to the prospects of Australian dollar. Singapore performed well this year, largely due to the high vaccination rates, which will lead to quicker reopening relative to their regional peers. China, by far, have been one of the worst performing segments this year, which is largely due to the regulatory crackdowns that we saw this year. On the other hand, in Malaysia's case, the weakness in Malaysian markets can be largely due to the weak performance of the rubber glove stocks this year. We saw rubber glove stocks fall more than 50% this year, dragging the Malaysian index along with it. This may be a simplistic way to look at things. However, if we were to look at this table, you will see that rarely do any particular country enjoy 3 consecutive years of returns. Even on cases that show 3 years of consecutive returns, such as the one we see in Hong Kong and China in 2014, the returns are rather subdued and can be largely attributed to massive losses in 2011. Now, let's move on to the issues that common prosperity have brought onto us this year. If we were to break down the performance of the Hang Seng Index, by far the worst performing sector would be the Hang Seng tech sector. Investors' confidence within this sector has been at a record low, as the prevailing sentiment right now is that the private sector are being turned into SOEs. I suppose most people would like to know whether they should still hold on to their Chinese internet stocks after the massive sell-off that saw Hang Seng Tech Index crash this year. Now, if you look at this slide, we're looking at the last regulatory crackdown on the Chinese tech companies that occurred back in 2018. Now, during that period, the Chinese government decided to limit the number of online games and reduce screen time. Now, new games approvals were frozen that year, which resulted into Chinese internet stocks tumbling. Now, if we investigate further, and you will see that Chinese internet stocks actually stayed at a trough level for approximately about 2 months before recovering. The situation we face today is without a doubt a lot more serious than what have happened in 2018. This year, the crackdown happened across various sectors. However, the education and internet companies are the hardest hit this year. Fortunately for us, we do not have any investments in Chinese education companies. However, we got hit quite badly on Chinese internet investments. So what are we doing at this juncture? We actually bit the bullet and decided to sell all of our position in Alibaba. So as we deem that the prospects of Alibaba has been fundamentally changed, we find that there's a high possibility that Alibaba could be run like an SOE, whereby the growth and profitability of the firm will no longer be its main priority. Now, if we look at this table, what we can clearly see is the disparity in valuation of the Asean or Asian tech companies relative to its Western counterparts. If we strip off the loss-making companies, the disparity between the Chinese tech companies against the American tech firms is even more glaring. You see, we are looking at about 11 times for the Chinese firms. However, the reason the American peers are trading at a significantly larger premium could be largely attributed to the lower regulatory risks, despite significantly higher ROE. We think that, with common prosperity policies in place, there is a high possibility that the profit margins of these ROEs, these Chinese tech companies, will face likely downward pressures going forward. Now, moving on, this chart, it exhibits the Chinese house price to income ratio. As you can see, the average house price to income ratio in China have been steadily increasing. It's now at close to 18 times, Hence, it takes more than 18 years of annual income for a Chinese citizen to buy a house on average. However, if we look closer at the housing data, the price to income ratio of the tier 1 cities is even more ridiculous. As Beijing, Shenzhen, Shanghai, their houses have ratios exceeding 40 times. This is largely one of the key concerns highlighted by the Chinese Communist Party. Simply put it, the average house price to income ratio in the America and UK is actually less than 10 times. Oh, sorry, let me back. Okay. So Chinese residential floor space under construction have been gradually moving higher to 6 billion square meters from 2 billion square meters 10 years ago, despite the housing glut. So why is the average home in China is getting more expensive and out of reach to most consumers, despite the housing glut that we are seeing today? Now, so from our standpoint, if we look at this from a different clarity, we could say that there's a disparity on in how they distribute wealth in China. Where you have people who are extremely rich and people who are not so wealthy, who can't really afford to buy houses. So if we really look at it, we are still seeing a lot of houses being built despite the glut. However, it's mostly massive townships in tier 1 cities, which is, eventually lead to ghost towns, as there isn't much demand for property in those areas, unlike those in tier 1 cities. Yes, so as we can see from this slide, land sales account to approximately 70% of the Chinese revenue, government local revenue. This explains why the local government officials have been extremely close to the Chinese property tycoons. Over the years, the Chinese SOEs have been supporting the Chinese property companies by providing various creative ways to finance their projects, despite measures introduced by CCP, such as the three red lines to constrain the property developers' debt, which you could say eventually led to the downfall of Evergrande. Now, President Xi has begun investigating potential corruption scandals among the local government officials. So, what we are seeing today is you're seeing a scramble actually where, all the government officials are pulling back on what they have done and, trying not to be too close to the, entrepreneurs in China. It's not exactly a great time to be, a massive entrepreneur in China. So, okay, in this table, we can see the correlation of the performance of the Chinese stock market relative to the outstanding margin trading balance. As you can see, the outstanding margin trading balance is slowly creeping up, creeping to 1.7 trillion yen today, which is not far off, from the 2 trillion yen in 2015, before the collapse of the Chinese stock market. We will not discount the possibility that the Chinese government may actually start clamping down on the high levels of margin financing, which would present downside risks on Chinese equity markets today. Now, regional small caps have been performing in tandem with their larger counterparts in the past 2 years. The MSCI World Small Caps have been the best performing index, followed by the MSCI Asia Pacific Small Caps, which is up approximately 20% from its pre-COVID levels. Now, in this table, we can see that the small caps in India, Hong Kong, Malaysia, Korea, and Philippines significantly outperform its larger counterparts. Now, the outperformance in Hong Kong is largely due to the regulatory crackdown on the Chinese tech companies, which is a large component of the index. Now, in Malaysian's case, we could attribute it to the sell-off in the rubber glove stocks. Now, where do we see opportunities at this point of time? ASEAN equities have been the biggest laggard regionally since 2013. We have converted the respective local currencies to US dollars for comparison purposes. Malaysia is by far the worst performing country within the ASEAN region. For every dollar invested in the FPM-KLCI, we will be left with 60 cents after more than 8 years, which is extremely sad, if you ask me. Malaysia not only underperformed our regional peers, but it's underperforming most asset classes. And your money would have been better off in, money market funds. However, because of the significant, huge underperformance relative to all its peers, we do believe that the Malaysian market have turned more attractive, especially with the possibility of a general election next year. Now, historically, the Malaysian market tend to see strong foreign inflows prior to the general election. We also like Indonesia and Philippines, as we are anticipating a rebound in their respective markets as they accelerate their vaccination progress. Equity outflows in the Asean region is starting to show signs of reversals. Malaysia have seen 4 years of consecutive foreign outflows. However, we are starting to see signs of reversals in the past few months, which explains the strong performance seen in larger caps, especially stocks within the banking sector. Now, on top of that, Indonesia and Philippines are also seeing positive foreign inflows in the past few months. Year to date, Indonesia and Philippines, the foreign inflows amount to 1.9 billion and 793 million US dollars. A reversal from an outflow of 3.2 billion and 2.5 billion last year. Now, we are anticipating that this trend will likely to persist in the near term. Okay. Central banks around the world are still in expansionary mode, despite the upcoming taper schedule that indicated by Powell. Now, let's not forget that interest rates around the world is still close to 0% right now. This has resulted in the wealth of US households to swell in the past few years. It has increased more than 20% to more than 140 trillion compared to its pre-COVID level. A combination of rising asset prices has catapulted the wealth of Americans, and we do believe that this will likely to persist as we are still seeing rising equity and house prices. With the current low borrowing costs, this would likely entice Americans to actually borrow money and invest in the equity markets or buy a house altogether. This also explains why we are seeing, the rise in, interest and appreciation in prices of alternative assets. I would say that this is it's new assets that wasn't here 20 years ago. Things like NFTs and cryptocurrency. So, we saw Bitcoin, breaching 66K yesterday, with the new, largely due to the new ETF in America. So, there's just so much liquidity in this market. And with the low borrowing costs, it just doesn't it makes sense for people to lever up to increase and improve their returns. Okay. We are still relatively bullish of equity markets because of the amount of liquidity in the market. The US money market mutual fund assets increased significantly during the COVID outbreak to more than $4.5 trillion at this point of time. And it has always been hovering at the 2.5 trillion level for close to a whole decade, until the central banks around the world decided to put, their money printing hats on. We anticipate that this trend will likely persist. Hence, we do believe that investors should consider deploying more capital into the equity markets in the event if there is a sell-off. Simply put it, we still think that buying the dip strategies will continue be the go-to strategy, and it's likely to continue to do well going forward. Now, based on the latest asset allocation survey, we find that the cash allocation have been relatively stable. Hence, the high level of assets in the money market funds is simply due to new money creation and not due to any shift in strategic asset allocation strategies. Now, in this chart, we can see that inventory levels remain to be at record low levels, despite bouncing off slightly in the past few months. We still think that the supply chain disruptions we see today to be very concerning, as it's likely to impact the global growth, because, that's just, lack of supply, lack of things to sell. With the festive season coming up, we think that the supply chain tightness will likely see, we will likely see shelves being empty prior to Christmas and the New Year's. In anticipation of that, so we do expect retailers, distributors to hike prices significantly, which would likely lead to higher inflationary readings in the coming months. And, this would likely coincide with the upcoming taper schedule, which, would likely result into a more volatile month or, more volatile market, in the next quarter itself. Okay, so we are currently bullish of the prospects of Indonesian coal miners. We have recently deployed about 6% of our portfolios to several Indonesian coal miners. As you can see from this chart, coal prices have increased more than 200% from last year. This largely due to the shortage of natural gas, which is, resulting into power outages around the world. Over the years, policymakers have accelerated their pursuit for carbon neutrality, which has resulted into massive underinvestment in various dirty commodities. Now, we think that this underinvestment in these areas, in these commodities, have resulted into commodities being one of the best performing asset class this year. The transition to green energy is unlikely to be smooth sailing, as it would probably take more than a decade of investments in renewable energies to being able to actually replace, your dirty energies or energies that, that's deemed not ESG friendly. As you think about it, coal itself generates close to 40% of the electricity generated around the world. A large proportion of energy generated in the emerging markets, which is where most of the growth segment is today, is generated by thermal coal. Even Malaysia, which also explains why, foreigners, don't really like to buy tenaga. So what we're seeing a trend here is, you saw foreign inflows coming into Malaysia this year, but, your banks have done very well this year. However, this is not trickled down to other areas such as, your utilities, your tenaga, because of the composition of its energy generation, which requires a big amount of coal. And also, we're not seeing it trickle down to the larger cap plantation stocks, which are mostly still year to date down this year. So it's underperforming actually, despite CPO prices hit close to 5,000. We would have never imagined, a couple of years back, when I actually spoke to other investors regarding, CPOs, potential investment in plantation companies. A lot of investors or fund managers or, industry peers would tell me that, it's not sustainable, and back then it's at 2005, 2008 levels. Today it's at 5,000 levels and the narrative is still the same. It's not sustainable. Now, obviously, you know, a clock will be right, a broken clock will be right twice a day, right? So we certainly feel that, you know, there are opportunities in these areas, these unloved areas, which is something that we are looking at and something that, you know, we do not mind deploying our capital into. Again, we always look after the best interests of our investors. Now, even with the high prices, you know, we see today, a large number of multinationals are still reluctant to invest in these areas due to pressures from shareholders. Hence, we do believe that this commodity, these bullish commodity trends that we see today will be sustainable. As firms who are not so concerned with ESG would likely be the biggest winner in this situation. Now, and that is what we have been trying to do, you know, invest in areas, unloved areas that we think there are opportunities to provide, you know, generate sustainable outperformance for our investors. Okay, now let's move on. Next slide. Okay, I'll take a drink first. Now, as you can see from this chart, the Baltic Dry Index have surged past its 10-year peak. Obviously, it's still far off from the levels, you know, that we see in 2008. You know, however, you know, you are seeing your Baltic Dry Index breaching the 5,000 levels. You know, you're across the board. You know, your Supramax, Panamax. You know, just shipping costs, freight costs have been flying across the roof, and firms are having difficulty actually adjusting to it. Now, we do believe that, you know, this will likely persist at least for the upcoming quarter, because Q4 is generally a seasonally stronger quarter due to the festive seasons. You know, you have your manufacturers, you have your distributors, your retailers, you know, trying to rush and stock up for Christmas. And they couldn't even get stock right now. They're willing to pay top of the line cost or charges, you know, to get the goods to their hands right before Christmas. Now, so what we're seeing today is, you know, your shipping companies are doing extremely well. And this is one area or avenue that we are actually looking at. We did invest into a dry bulk shipping firm, which we think would likely do well for not only this upcoming quarter, but maybe for the next few quarters, especially if you got an extremely cold winter. Now, China. Why Chinese government have been so fixated with, you know, with carbon neutrality, you know, trying to be zero carbon zero. Especially they are trying to reduce the amount of emissions, or at least maintain the levels that we see this year to next year, because it's Winter Olympics. In this slide, you can see that the Chinese carbon emissions have been steadily increasing in past few decades to account to close to 30% of the global carbon emission today, which also resulted into a lot of pressure from the Western counterparts of the more developed countries, you know, in pushing China to reduce its carbon emission. Hence, the Chinese government have taken drastic measures this year to try to reduce the carbon emission this year. We are starting to see, you know, factories being shut down, you know, because, you know, they need to meet a certain level of threshold. And this is trickling down to several different commodities. like chemicals, coal, the steel industry, aluminium, paper, various industry across the board in China are being severely impacted by this power outage or forced shutdowns, which is why we are actually, if you look at this slide, we are still quite bullish of steel prices going on for continue increasing for the next few months. Obviously, the Chinese government have taken measures in the past in trying to restrict the appreciation of steel prices. However, it's just too difficult because the demand and supply dynamics is just not favorable at this point of time. There's just a lot of demand, and due to the supply chain disruptions that we're seeing, it's just difficult to suppress steel prices at this juncture. Now, if you look at this table, we are starting to see that the Chinese steel production is starting to normalize. Historically, China in the last 10 years have accounted to 50–60% of the global steel production. Hence, whatever action or controls that the Chinese government set in place will severely impact the steel prices, because it's going to impact on the supply end. You think about it. If you account to more than 50% of the total steel production, you're essentially very close to a monopoly or duopoly in this segment. Now, Hubei province have seen shutdowns time and time again, operating at 50% capacity. Now, we like to say that, steel prices are extremely high right now. You encourage people to operate, but it's a bit different from the past. In the past, you get a lot of businesses or state governments define the government's actions or government's directives due to, everyone's looking after their own interests. However, this year, we are seeing President Xi clamping down, investigating whether there's corruption or scandals among local officials, which, cause all the local government, state governments to scramble to try to meet the targets set by President Xi. We saw a bunch of exodus of state government officials in Shenzhen for failing to meet the directives of President Xi. So going forward, we do believe that unlike what we've seen in the past few years, the Chinese government will likely, clamp down and suppress the production. Hence, we do not foresee any more supply growth of steel production in China going forward. Now, if we look at the steel price in China relative to the global steel price, we are seeing that the Chinese steel is trading at a 2–3 percentage point discount to global steel prices. Why? Because the Chinese government have taken all kinds of measures to clamp down on speculation on steel prices, force traders to liquidate their positions, warn them not to take speculative positions. And it's just difficult actually. At the end of the day, after it's only successful for a brief period. However, the steel prices eventually just rebounded back again. Now, when we look at what's going on in the past few days, we're actually seeing similar trend in the thermal coal markets, because thermal coal have soared. So the Chinese government have allowed the Chinese electricity utility producers to increase their electricity rate in China. However, they're still selling at market rates to the industrial players. So what happened is the Chinese government have encouraged the Chinese coal miners, mining companies, to increase production. Now, obviously, initially when I was bullish of thermal coal, I did consider whether I should invest in the Chinese coal players, since they have a power outage there. And they ban coal imports from Australia. So it seems like it's a good, proposition to invest in these Chinese coal players. But after much thought, I decided against investing in these Chinese coal players due to what I've seen in the large cap stocks in China. Your Chinese internet companies, your Chinese education companies. Then I realized there's a similar trend here. The Chinese government do not care so much about the business itself, or at least large corporates. They do not want supernormal inflated profits. They care more about the people of China, which is in the long run a good thing for China. But in the near term, it's actually very negative to the large Chinese companies that most foreigners invest in, which explains the underperformance that we're seeing today. Now, we think that the decline in Chinese coal prices that we're seeing yesterday and today is not sustainable. We have seen the Zhengzhou thermal coal prices drop more than 11%, which is the maximum amount, the futures are allowed to drop in a single day. However, according to Reuters, channel check shows that the spot price of the Chinese coals have actually went up 7% during the same period. So if you are speculating on Chinese coal futures, that's bad. But if you're investing in a coal company for the sake of profitability of the company, then it's a great investment, a great investment proposition. Hence, we do not think that the decline in coal prices in China that we see in the past few days to be sustainable. As time and time again, China tried it on copper. It did fall a while, but back to its all-time high again, close to its all-time high again. It tried on steel, failed. Aluminium, failed. So we do not believe that, what they're doing to thermal coal today in China would be sustainable. Now, why am I bullish of the equity markets or risky assets in general? If you see, the amount of US Fed balance sheet have expanded since the COVID outbreak that we saw last year. Since they started their unlimited QE plan, constantly just printing money, combined with the fiscal spending by the US government. You see the balance sheet have swelled more than twice. You're seeing money growth, the growth of M2 by more than 20% a single year. So then it explains why equity deserve to go up more than 20% a year, because essentially there's just so much more new money in the system. And even with the Feds talking about tapering or actually tapering this in the next few months, what we're seeing here is there's still a lot of money in the system. Interest rates are still at 0%. And if there's any sign of an economic slowdown, I will not be surprised that the government, or at least the US Feds, will resume back their bond purchases. Now, what we have been seeing in the past few years, the trend was that, there's a widening between the growth and value stocks. We are seeing that growth have been outperforming value stocks since the COVID-19 outbreak last year. And the disparity is wide, to the point that today, S&P 500, a big amount of its composition is mostly tech companies. So what we're seeing today, at least in the past few months, is value, have started to rebound slightly, as it did rebound strongly at the start of the year. Because it seems like there's a strong correlation between lower interest rates and stronger growth stocks. So we are starting to see a reversal in that relationship, where we have been seeing actually at the start of the year, value stocks outperforming. And if you really think about it, there are some areas where these value stocks will do extremely well because, think of your commodities, your energy companies. These are the old economy stocks that will likely announce supernormal profits in the coming months. Hence, we are bullish in that segment, but we are not out of growth stocks altogether though. We still hedge some of our exposure and we still maintain some of our investment in these growth companies, as we think these few investments such as TSMC, C Limited still have great growth prospects in the coming years too. Now, if we look at this slide, you will understand why I am bullish of the prospects of investments in the Asean region. As you can see, the COVID-19 vaccination rates, the percentage of population that receive at least one dose in Philippines and Indonesia are lagging behind the global average and far behind the more developed countries. And what we saw recently, where as we vaccinated more than 80% of our Malaysian population, we saw foreigners start buying Malaysian equities, start injecting, capital into the Malaysian market. So we do believe that, in the coming months, we may see similar trends in Philippines and Indonesia as these countries accelerate their vaccination rate. And I do believe that, certain areas would likely outperform the overall broad-based market. One area that I'm very excited of is the tourism and leisure sector. Now, as you can see in my portfolio, one of my top holdings is my investment in the largest Japanese hotel REIT. As I do believe that if the price of this stock were to recover back to its pre-COVID levels, I'm seeing at least 30% upside. Today, this Japanese REIT is forecasted, the consensus forecasted, to actually generate close to 5% dividend yield, which is something that's unseen or unheard of in Japanese REITs. So we do see a lot of potential in this segment. I'm also invested in one of the key travel insurance companies in Malaysia. So this is an area that I potentially see that have a lot of room to grow in the next year. Now, we're towards the end of the presentation. So as you can see from this slide, the KAF Jade Fund, time and time again, have shown that it could outperform its closest peer or its benchmark, the MSCI Asia Pac Index. Now, a lot of people highlight that ETF is the cheapest alternative or cheapest place for us to have exposure to the equity markets. Warren Buffett said, many prominent investors have highlighted that, the low-cost ETF by Vanguard, it's just the wise thing to do for investors. But from our standpoint is this: essentially, the returns that we see today, or the performance that we see today, is net of fees. And we have shown net of fees, we are outperforming the Asia Pacific Index. We are outperforming our ETF peers. So I do believe that, investing in KAF Jade Fund would be as good or even better than investing directly in the Asia Pacific, MSCI Asia Pacific ETF. Fortunately for us, past few years our fund have done really well, and we're blessed. We made the right decisions in the past few years, made good investments, which generated and created a lot of value for our investors. Now, last year, KAF Jade Fund actually won the best fund in the Asia Pacific category, from Lipper, it's awarded by the H Lipper. So, hopefully, we can sustain this performance going forward. And we hope that, investors or potential investors who are dialing in today, would consider investing in our fund. I think that's all from me today. I'll probably move on to Q&A.
Yeah, thank you, Mr. Tan, for the sharing. There are a few questions coming in. Right, the first one will be, do you think there is more opportunities in the local Bursa stock market or the Hong Kong, China market? What's your view?
Okay. You see, I do manage local domiciled funds as well. I manage KAF Tactical Fund. I think I had a presentation a couple months back as well. So I do believe that the Malaysian market is an attractive market. Considering, I think one of my slides earlier, I've shown that, if you invested a single US dollar, in the Malaysian market, it would have only be left with 60 cents today. So, and it's far lagging behind all asset classes. So there's a lot of room for a rebound, room for appreciation. Nevertheless, I think that to look at KAF Jade Fund as a Chinese fund, it's inaccurate or a misrepresentation. Because right now, at this juncture, KAF Jade Fund, we like the Asean region a lot. We are looking closely at the developments in Indonesia, looking closely at developments in Philippines, to look for investment opportunities. As I mentioned earlier, I've invested about 6% of the fund in the coal players in Indonesia. So I'm right now, I've trimmed my position in the Chinese companies. I would like to take a wait and see approach. The last time round we saw when there's a regulatory crackdown, the gaming crackdown, we saw that the stock prices actually stay at the trough levels for about 2 months. And we're seeing similar trends right now. However, in the past 2 weeks, we saw the Chinese internet companies, I think, appreciating close to 20%. It actually rebounded about 20% from its low in the last 2 weeks. Several factors come into mind. Number one, people think that the Chinese government is starting to pull back. They saw that the fine that the Chinese government placed or implemented on Meituan is a lot less than initially expected. Furthermore, people saw Jack Ma being able to leave the country. He's seen in Spain today in his very expensive yacht. What I heard, partying and karaokeing with his friends, traveling around Europe. So people are having the impression that Jack Ma is off the hook. I suppose that nothing would happen to Jack Ma. But my concern is that, with the intervention from the Chinese government, you're seeing that they're placing, new rules, new set of rules to the Chinese internet companies, making it more difficult for them to do business, more expensive to do business. They are forcing the Chinese companies to pay more for the Grab drivers, the delivery driver, the logistic drivers, which would, by default, increase their cost structure. Hence, the biggest fear we see today is whether, yes, Alibaba is cheap by historical means, no doubt about it. We are seeing Alibaba trading at 16 times, versus Nasdaq, at 20, 30 times. But the fear here is, can they deliver the soft earnings growth that the consensus is expecting? With the rising cost structure, and because they have to open up to competition, the Chinese government is actually promoting or helping these SMEs to move up. And back then, Alibaba can squeeze the merchants in their Taobao platform by forcing them to only sell exclusively in Taobao and not in their competing platforms like JD. So that inflated their profit margins. Right now, they are allowed free game for all. You can sell in Taobao, you can sell in JD. And not only that, today, you can pay for your purchases in Taobao, with not only Alipay for the Chinese people, but with WeChat Pay as well. So government's opening up, trying to remove the economic competitive advantage that they have built. Warren Buffett always say economic moat, the government is trying to disrupt that economic moat that we have seen in the past few years. So with all that in mind, if the tech companies or Alibaba were to be run like an SOE, we are likely to see the profit margins declining from what we saw 20% in the past to maybe single digit level. And from like an end group level, you look, it used to be extremely profitable, but the government is putting banking regulations on top of it, and they will need to increase their capital requirement. So the profitability of N Group will be impacted, which explains why, the new valuation we're seeing today with N Group is likely going to be less than 50% of what it was supposed to be listed in the past. Hence, I am right now still taking a wait and see approach with Chinese equities. I am more bullish of the ASEAN equities at this point of time.
All right. And then there's another question, right? For your Chinese equities that you are invested in, it is in the A share market or the H share market?
Okay, we do invest directly in the H share market. We don't invest in the A shares. And on top of that, we also invest in the ADRs listed in America. So at time and time again, there are, even though the American government is trying to delist some of these ADRs, we still have investments that's listed in America. They are Chinese companies.
All right. And then there's another one. With less than 20 million in fund size, how agile is Jade Fund to maneuver?
Okay, so for us, I think I've mentioned this a lot of times in the past, because generally KAF is not exactly a bank, a very big asset management firm, but nevertheless we are very niche at what we do. We like to see that we are specialists in what we do. So from my standpoint, a small fund size will always be beneficial relative to a larger fund size, because there's always a liquidity premium. You see, every time when you buy and sell stock, you do incur liquidity costs. Because imagine if you're managing tens of billions, right? When you were to purchase a stock, like it or not, you would likely push the stock price higher. Hence, what you see in your portfolio, the average cost of your investment would likely be higher than the entry point or the first investment that you have made. Hence, this is what I mean by liquidity cost. But when we're talking about fund size of 20 million, look, I don't even, if I were to want to invest in any stock, I don't even need to buy it throughout the whole day. Time and time again, there are times where I can just take the bid, whatever is in the queue, and my orders would be completed in less than 5 minutes. So I would say for regional fund, anything, the smaller the fund is always better, but we could accommodate the same type of liquidity cost all the way up to 200-300 million, no problem at all.
All right. Okay. And then there's a few similar questions asking, how do you believe in the China market will stay depressed due to the ongoing turmoil, and how do you see this, especially the housing tech sector-wise has been plunged for quite a big chunk. So is it a good time to actually look into it?
Yes. Okay. So within the Chinese tech sector itself, housing tech sector, which I suppose that a lot of the stocks have fallen 40 to 50% from its peak level. So it does look very attractive to most investors. I'll be careful with some stocks. Like at this point in time, I've cut all our losses in Alibaba. I would stay out of Alibaba for the meantime. But I am closely monitoring some other tech companies within the Chinese tech ecosystem. There are areas where, the Chinese government are promoting. There are also areas that, these Chinese tech stocks that got sold down that would actually benefit from the, the current new policy set in place, because these are players who previously struggled to expand, their size or exposure. But because of the clampdown from the Chinese government, it gives them the opportunity to capture these additional markets. So there are areas within the Chinese tech sector that I'm looking closely at, and I would be considering to make an investment or two in these companies. But there are some, like I will stay away from the Chinese social media companies, because gaming is just not something that the Chinese government likes. Your TikTok, your Kuala. We used to have Kuala. When we saw something's not right, we just cut off our positions. And unlikely I'll go back into Kuala, because the Chinese government, again, with this common prosperity, they are trying to improve the well-being of the Chinese people. Do you know that more than 50% of fresh graduates from China today are actually graduates coming from the School of Engineering or with engineering background? The Chinese government is taking measures to actually promote the tech sector. So we do not believe that the tech dominance that we see today in America or in the Western counterparts to be able to sustain at this level going forward. So I do believe that there are some Chinese tech companies that would do well going forward.
All right. I think I will pick one last question, right? Okay. So do you use the same strategy for this KAF Jade Fund as the same as KAF Core Income Fund, because that one has been outperforming from the past until now? All right. And then also, what's the KAF Fund asset allocation in ASEAN and China?
Okay, as for KAF Jade Fund, KAF Income Fund, or KAF Vision Fund, KAF Tactical Fund, KAF Islamic Dividend Fund, all our funds, our strategy do vary according to the funds. So there's a reason why we have a selective list of funds for being sold to investors, prospective investors. Generally, some funds carry higher risk profile than other funds. Like Vision Fund, being a small cap fund, do carry a higher risk profile compared to what we see in KAF First Fund or KAF Tactical Fund. So as for KAF Jade Fund, again, all funds, our goal is to maximize our risk-adjusted returns. Again, we always look to maximize our risk-adjusted returns. So like if Vision Fund were to outperform KAF Tactical Fund, what we can see, that, it's because KAF Vision Fund is predominantly a small cap fund. Hence, it's a bit more volatile, the risk profile is also a bit different. As for KAF Jade Fund, we look at it as a Asia Pacific fund. We like ASEAN right now, and we look to maximize our returns in this fund. Of course, always on a risk-adjusted basis. So we do have a more diversified portfolio, and how I try to hedge my bets. It's basically like I mentioned earlier. Despite me being very keen on the tourism and leisure sector, on the reopening segment, I still keep some of the growth stocks, like TSMC or C Limited, because C Limited, we are seeing a scarcity premium because of what's happening in the Chinese internet companies. We see that a lot of investors or foreign investors are staying away, but they still want the exposure, because like it or not, the growth of the internet segment, of the e-commerce segment in Asia, it's just strong. It will be stronger, because what we see in the Western counterparts, they are actually operating in a more saturated market, a more developed market. So C Limited, being the owner of Shopee, remains to be one of the best proxies for them at this point in time. And because it's actually located in Singapore, despite having an owner, Forrest, which is a Chinese individual, it's located in Singapore. So it's a Singaporean company. So it will not be subject to all these regulatory crackdowns. And not only that, they can take the opportunity to actually capture more market share from their Chinese e-commerce or internet counterparts.
All right. Thank you so much, Mr. Tan, for the insightful sharing, right? The presentation and also the Q&A session. It's very interactive, right? And then, of course, there are still more questions written down there which we couldn't answer at all, right? Feel free to drop your further questions to our email at investhub.my@fundsupermart.com. So currently, there's a campaign going on for this KAF Jade Fund, okay, from 15th of October 2021 to 29th of October this month, right? For every 10,000 ringgit invested in this fund within this campaign period, we get to enjoy 100 ringgit worth of prizes, which consists of 50 ringgit worth of Wolf Juice e-gift card and 50 ringgit worth of big e-voucher. Right? For more information on this campaign, kindly click on the link provided in the chat box later, okay, to know more about the terms and conditions. And a replay of tonight's session will be available right after this. And you may head over to our YouTube page at FSMOne Malaysia to catch the replay. Right? Once again, thank you very much, Mr. Tan, for joining us today. And thank you everyone for attending tonight's session. All right, good night, and we'll see you next round.
Thank you, everyone.
Thank you so much.